The market reveals its most significant developments not during periods of sharp price movements, but long before them. When the chart looks dull, volatility is low, and most market participants have lost interest in what is happening. It is precisely during such periods that future price momentum most often takes shape. I used to view consolidation phases as pointless periods when nothing happens. Now I realize that this is precisely where the real work of major players begins. Whilst the crowd waits for dramatic movements and news, the market gradually gathers liquidity and prepares the ground for the next stage. A similar situation recently occurred with gold. After several days of decline, the price moved into a very narrow range. Volatility dropped, the market seemed to freeze, and most participants lost interest in the asset. But it is precisely these phases that I now try to analyze with particular care. I noticed that, despite selling pressure, the price had stopped actively testing new lows, whilst volumes at the lower end of the range began to rise gradually. This looked like a hidden build-up of positions. When gold finally broke out of the consolidation phase, the move turned out to be much stronger than expected. But the most important thing was not the momentum itself, but the realization that the market had been showing signs of a shift in the balance between buyers and sellers in advance. A similar example occurred in the GBP/USD currency pair. Following the release of strong economic data, the market initially surged sharply, only to reverse almost entirely. To most, this appeared to be a sign of weakness among buyers, but I noticed something else. Sellers were unable to establish a foothold below the key level, despite the high volatility. This often suggests that the market is absorbing selling pressure before a further upward move. Such moments particularly highlight how important it is to analyze not only the momentum itself, but also the price reaction that follows. Very often, the market's behavior following news contains far more information than the news itself. When it comes to shares, I am increasingly focusing on relative strength. When a sector as a whole looks weak, but an individual company continues to hold its levels and recovers quickly after pullbacks, this becomes an important signal. Sometimes major players start accumulating positions even before the positive trend becomes obvious to most. With experience comes the realization that the market almost never provides ideal conditions. There is always uncertainty, and there is always a chance of error. But a trader's job is not to predict every move, but to spot the moments when the odds start to shift in your favor. That is precisely why I am now spending less time looking for perfect entry points and focusing more on the logic behind what is happening. Because sound analysis does not begin with searching for a signal, but with understanding who is driving the market at any given moment and why.